我哋可以
So, shall we resume? Yes, Chair. There are two fair value accounting systems, and if we do that, will we be looked upon as challenging the judgment of the court and therefore create trouble for companies which adopt the other method of accounting? Mr. Chung, can you be clear? What do you mean by two fair value systems? What are you referring to, please? Chair, I mean, that is, before the realization of profit, there is already a booking of profit for tax purpose. And now there is an option for companies, a choice, and the company adopts, if it adopts the other method, it doesn't have to pay tax. And that being the case, would people think that we are challenging the ruling of the court, and therefore the IRD would perhaps take action against such a company making such a choice? Now, another scenario where a security is bought at $10,000 and the value had appreciated to $15,000. If we use the usual method, then there will be a $5,000 profits. Now we're changing that. With the change, when I realize the profits, and only when I realize the profit do I have to pay tax. And given that, would the cost be $10,000 or would it be $15,000? Is this specifically provided for? Which one should it be? Let's say if it is $10,000, then would the government repatriate the $5,000 or give back the $5,000 to the company? These are my questions. Mr. Chair, for Mr. Chung's questions, first of all, this amendment, is it in conflict with the CFA judgment? I believe it is not in conflict at all, but rather it provides a clear and solid legal basis for the IRD and taxpayers so that they totally understand that they have the choice. Fair value accounting for tax reporting purpose, that they have this choice. And this arrangement would not be conflicted with the CFA judgment. And this is because for the accounting standard to be adopted for tax reporting is really up to the company. It can be on fair value basis or on realization basis, as long as it is consistent, so that the tax and the financial arrangement can be done on consistent basis. That is the rule. Now, just now, Mr. Chung mentioned another situation for financial institutions. For the majority of them, and also the members of the deputations, I'm sure, they would want the IRD to accept fair value reporting. If we are to force them to adopt the realization method, it would actually bring on a lot of inconveniences and costs for their financial reporting, and we do not want to see this. So this amendment actually is in accordance with the need and demand of the industry, and also it closes the legal vacuum for the legal basis, as pointed out by the CFA in the case. Now, as for the other question, can a company or financial institution change its tax reporting method? In the law this time, with the amendment, we provide that space for the company to apply to the IRD, and the IRD in the consideration of the application will consider whether there is a tax evasion or tax avoidance intention or situation. If there is none such situation and the financial institution had been using fair value methodology, but let's say it's been acquired by a new parent company or group and the group has adopted the realization method, then this new member as part of the group will have to follow the group's practice. Chair, that's not what I meant. What I meant is, with the court ruling, the company opts to change the methodology. It is because of the judgment that the company opts for a new methodology. You should allow the company to do that as well, rather than to say that the only situation where this can happen is where the company is acquired by another group or a new parent company, right? So the company is changing its methodology or the system. What reasons does this company have to come up with for so doing? Mr. Chung, you're saying that the law allows us to opt between A and B. Let's say a company opted for A and now it opts for B or vice versa. Does a company have to provide very full reasons? But of course, a taxpayer's reason would be tax saving for this year. Not sure about the next year, though. But to provide reasons for change of methodology, whether it be fair value or realization principle, there should be full and satisfactory reasons given for that change. And how would you consider this, and under what circumstance would you be able to turn that application down? Chair, I understand the question of Mr. Chang. There are two requirements. First of all, this taxpayer or this company will have to provide reason to the IRD why it wants to change its booking principle. Now, if the reason is not for tax evasion or tax avoidance purpose, then the IRD can consider granting that application. And if that is the case, with the new accounting principle adopted, then the profits and losses should have been dealt with the original accounting standard before adopting the new accounting standard. The IRD, please. Now, let's take an example. Realization method is adopted, let's say, by a company according to the nice chair judgment. If the fair value method is now to be adopted by the company, then the company does not have to tell me any reason. All it has to say is to say that it's now chosen fair value method. But now if it's moved to the fair value method, it cannot say that this year I want to adopt fair value method and next year not. So you're saying there's only one time for such choice?
Yes, that's correct. Members, any further questions for the deputations? Mr. Zhang? Deputations have talked about liability of they can be liquidity. Some deputations have talked about expected impairment, and some refer to the different approaches of Singapore and Hong Kong. What is your worry? That's what I want to understand. Are you worried that the amendment bill is not clear enough and that you would like to have more guidelines? And if you talk about debt, well, I'm not talking about long-term debt of company. Maybe we're talking about trading stocks and short-term debts in the balance sheet. Are there any problems in that area? So I would like to seek a clarification. Maybe who can answer my question? Mr. Choi, from the Taxation Institute of Hong Kong, I've quoted one example. And going by the existing law, maybe deduction cannot be granted. I purchased some bonds in the secondary market. It costs $100, say, and then we go by the fair value accounting. Maybe it has dropped to $90. That means $10 is the credit impaired ECL. So in that case, that $10 may not be deducted because we need to have meet two requirements before tax deduction is allowed. First, the bond is not a loan lent by a taxpayer in the ordinary course of business, and the bond is not a trade debt, is not included as a trading income. So in that case, if I buy some bonds and I suffer a loss, so that loss cannot be tax deductible then. I understand then. There are three different types of debts, but I'm talking about debts which can be traded on the market, notes and bonds in actual terms. They may be linked to their value may be linked to the rise and fall of interest rate, and maybe the company issuing the bonds, the bond issuer, seeing devaluation of the bonds. So in our balance sheet, well, debt recoverable is a different scenario. Or loans receivable is a different scenario. If the company is winding up, of course, that can be written off. But for bonds bought in the market value has dropped. But then for other derivative instruments, the loss can also be is also tax deductible. Well, the nature of it maybe is loan and not derivative instrument. That's why it cannot be tax deductible. So can the Deputy Commissioner respond? Let me give you some background. The amendment bill doesn't intend to change the practices in relation to financial instruments. Now, there will be a territorial-based principle. Whether it's a revenue asset or capital asset, well, the treatment approach is the same. If the FI is on revenue account or trading asset, the RD's view is that normally the rise and fall will be reflected immediately in the profit and loss account. But the question now is, maybe the enterprise will not be reflecting that in the profit and loss account. That may be possible. Then we will accept that in the course of tax computation or in the tax computation table, we would go by the approach of an adjustment and then treat it as if it is a trading asset to make the relevant adjustment. Let me give you an analogy here. Right now, we have revenue asset and capital asset. If the taxpayer, say, consider them as trading assets, then all these will be reflected in the profit and loss account. But if it is a capital asset and then it is they think it should be a trading asset, the RD can also accept that, provided an adjustment is done in the calculation. Mr. Wong. I would like to respond to Mr. Chiu's point. I agree to his calculation method. If the adjustment of the fair value is not in the profit and loss account, but rather in the OCI, then that's something different, and we have to look at the nature of that item. There is a presumption or assumption. Now, if it is included in OCI, other comprehensive income, then, well, the assumption is that the item is not of a trading nature. So I hope that Mr. Chiu, you can write down clearly what you have said, because the practice notes are read not only by the taxpayers but also your colleagues in the IRD. So if it is included in the OCI, well, if a revenue is included in the OCI and we tell the IRD colleagues the same, then it's difficult to convince them this is the case. But then the Mr. Chiu said that OCI does not necessarily cover capital items, but also trading items as well, and I agree to that. Mr. Chiu, any further response? Would you set that out clearly in the practice notes? Yes, that will be detailed in the practice notes. Mr. Wong's understanding is totally correct. Well, if it is not included in the P&L, it is included in the OCR. We have to look at the principle. We have to look at whether it's a revenue asset or capital asset. This is a fundamental question. All right, any further questions to put to the deputations? So I'll give you the last opportunity. Deputations, do you have any questions for the administration? If not, then I will take up your time. If you have some written submissions, please hand them to our staff. Thank you very much. On the deputation's views, including their written submissions, can the administration make a written response? In the past, you would be compiling a table in response to the deputation's views. Please give the same to the Bills Committee before the next meeting. Before the meeting today, we have received several documents. And there are documents which have not been discussed in the last meeting. So let's take a look at the first set of documents, and that is the matters arising from the meeting on the 30th of November. In the last meeting, members have made certain requests. We have asked a paper to be prepared on the court case, and that is LC paper number LS26/1819, and that is the ruling on the Nice Cheers case. It was legal advisor. Did you write up this document? Please take us through that document. We have actually discussed this case, Nice Cheer, but just to make sure that we cover everything. So let's discuss this meeting. In the last meeting, some members have asked me to write a short note to explain how the Cheer case is related to the amendment. Well, I agree. My stance is similar or the same as the government. The amendment bill is not to revoke the CFA ruling or reverse it. It is doing two things. It is confirming the CFA's ruling, and that is under the existing IRO, unrealized profits should not be taxable. So that's that will be kept. And if taxpayers would like to have their tax assessed in that way, that approach can still be adopted. And the amendment bill, as a major change, is that a new basis can be provided to taxpayers, i.e. fair value basis can be used for tax reporting. And that is the taxpayer have two choices. One is the new approach, the other is the old approach. So this is the real, the gist of the amendment. Administration, any supplement on this? on this paper, yes, we agree with the legal advisor's view. And that is why, in our explanation to members of deputations just now, we said that our amendment bill meets with the requirements of the CFA's ruling. And it is not the IRD which dictates the method used by the taxpayers in tax reporting, whether they are using fair value reporting or realization reporting. It's up to the taxpayers. So we are providing two channels for the taxpayers to choose from. Members, on the Nice Cheer case, any other questions? If not, then let's take a look at another legal advisor's letter to the administration, and that is, well, there are in fact two papers. One is the 12th of November, the other 30th of November. The one is rather technical in nature, and that has to do with individual provisions. So, legal advisor, do you think one of the papers should be discussed when we come to the clause-by-clause scrutiny? Or should we be discussing both papers now? Because I would like very much to have a discussion on the policies first. Yes, can you enlighten us on this, please? We have issued two letters to the administration, which has to do with technical drafting. So I'll suggest that maybe when we come to the clause-by-clause scrutiny, we will look at those. Now, there is one question which I would like to follow up on the tax reporting on the financial instruments, and that is in paper on the 30th of November. The government has already made a response. My concern is that in relation to the Nice Cheer case, the government has made an administrative interim measures allowing the taxpayers to have tax reporting on a fair value basis. As a result, the unrealized profits are subject to taxation, and that goes against the CFA ruling, because CFA said that these unrealized profits are not taxable. Now, this is an interim measure. Have you gone? Has this been an ultra virus on your part, Mr. Lai? Well, these are the interim administrative measures implemented by the IRD. We are actually dovetailing with the CFA's judgment. The CFAs has sent out a ruling saying that the IRO doesn't expressly provide for computing tax based on unrealized profits. But if we are to implement the CFA's judgment immediately, asking all the taxpayers, including taxpayers which trade in financial instruments on a frequent basis, to change to a realization approach from the fair value approach, that will make it very difficult to their operation. So based on the trades requests, we are putting in this administrative interim measure to meet with the requests of the trade. And the beauty of this interim administrative measure is to allow the taxpayers to opt for the method, the tax reporting method they would like to do. We don't compel them to use a fair value reporting. But if they have opted for a fair value reporting, the IRD then will tax their unrealized profits as well. So these interim administrative measure was put in place in response to the trade's request, and the taxpayers could have the option as to whether they would opt for fair value basis or reporting. That doesn't go against the CFA's judgment. Would there be a possibility that some taxpayer will lodge a judicial review against you? Well, touch wood, for the past several years, where the interim administrative measure was put in place, nobody has ever challenged such an administrative measure by the Commissioner of Inland Revenue.
Anything else? Any follow-up? Well, it seems that the IRD stance is that the taxpayers are voluntary in so doing. They're happy to do so. As for the judicial review, there is a 3-month period. If it is a restitution basis that the case is brought, then there would be a 6-year period. So even though the taxpayers are happy now, but on the other hand, if they are unhappy sometime in the future and they want to recuperate the tax that they have paid in the past 2 years, let's say, and we don't know whether there will be such people, then, well, strictly, if they bring up a case against the IRD, then the courts will, of course, handle such cases. But there is an administrative point I would like to bring up, and that is, even though, let's say, the fair value basis is used for reporting, the taxpayers can also take out the unrealized profits, and those profits will be exempt from tax. Do the taxpayers know this? I mean, accounting-wise, they will have to use a fair value basis to prepare their financial reports. But do they know that in terms of tax payments, do they know that they do not have to adopt that method? I mean, perhaps an IPN should be issued by the IRD so that they know, taxpayers know, that there is a choice. Thank you, Chair. Thank you for the opinion, legal advisor. I think in the future, in our practice note, we will clearly lay out the nice chair case and its ramifications. But also, we provide a message to the corporations where they want to use fair value basis for reporting. They can do so, and they actually have that information clearly from the IRD. It's been already provided to them. All right. Now, let us look at the previous meeting matters arising. There is a CB bracket 1337 181902. There is this paper. The 02 paper responds to 2 to 3 issues that were raised in the previous meeting by members. Do you want to go through that paper, please? Yes, thank you. In the past meeting, there were a couple of issues raised, one of which was the handling of the nice chair case, and I think we've spoken about that at length just now, so I'll not go through that again. And another is the amendment of the law concerning the researcher and teachers clause, and there may be a double non-taxation situation arising. On this particular point, I would want members to understand that this special arrangement is applicable to jurisdictions that have non-double taxation arrangements or agreements signed with Hong Kong, and it's only applicable to teachers and researchers. Only then will this arrangement be triggered. And compared to where there is no such arrangement for the burden on the taxpayer, in fact, there will not be any additional burden on the taxpayer. So why do we want to include this particular clause? It is because we want to avoid OPEC concern point, which is the double non-taxation situation, to avoid such detrimental tax measures. And we in Hong Kong do not want to have such a rather unsatisfactory arrangement. And that is why we have spelled out in the 3 scenarios for the taxpayers' burden what exactly it will be under the different scenarios. If there are any questions, we're very happy to answer the questions. Concerning this particular response, is there any questions, please? Now, concerning teachers and researchers, the example is very clear. I just want to confirm one point. And that is in clause 10. Bracket 1AB under section 8. So that's C1996 in the Chinese version, 1997 English version. It says a person is a visiting teacher or researcher in a territory outside of Hong Kong, and basically the person will have to prove to the satisfaction of the commissioner that the person will have to the taxes paid or payable in the territory in respect of the income of this person. So either it is because of allowance or because of exemption, the person does not have to pay tax in the territory concerned. What scenario are you thinking about? Well, basically, this is where there is tax payable responsibilities in that territory. So you're saying whether it's exemption or allowance, as long as there is a tax to be paid or payable, that would be the case as mentioned in bracket 1AB here. Is that right? Correct. All right. Let's go clause by clause now. Let's look at the blue bill, and we will look at the English version. The Chinese version is facing the English version page by page, and I hope that we will go through the English version of the amendment bill. And would you want to bring us through the amendment bill, please? Yes, Chair. Let us look at the long title first of all. And it is a Inland Revenue Amendment Number 7 Bill 2018, Amendment for aligning tax treatment of financial instruments with their accounting treatment. And it further talks about the exchange of information. This is because of the OECD proposals, and it is exactly on the basis of OECD proposals that we have made the proposed the amendments. And then there is the double non-taxation possibility for visiting teachers and researchers. And then there is the siblings definition. And this amendment is because of another section of the IRO, and therefore there is this amendment. As for the short title, this ordinance is to be cited as the Inland Revenue Amendment Number 7 Ordinance 2018. Hold on. I think after 7, you then have an onshore fund, which is using the full name instead of the number. I have an opinion here. If you only use the number, then the citizens or the members would not know what the ordinance is about, because every year there are different amendments. So my proposal is as follows. If you adopt a descriptive approach, and that is describe the bill, what it does, that is good. But at the same time, we also want to have people know that this bill had been amended however many times this year. Can you show both? Can you think about whether you can show both? That is, how many times a bill had been amended and also what the bill is about. Can you perhaps include both information in your title? Can you answer that question even now? Chair, I understand what you mean. I think we can go back to and discuss this with the DOJ. so that the title can include both, but it may be longer than what it is now. Well, longer is fine, but as long as it's clear. The number is informational in providing information on how many times the bill or the ordinance had been amended. Legal advisor, you have a point, please? Yes. I think spelling out the subject matter is important. Sometimes we get confused ourselves because there are a few of these bills being handled at the same time at LegCo. And also, as for the number, at the amendment stage, it may be different from the actual bill passed. So I think it is important, as the chair mentioned, to mention how many the number so as to illustrate how many times the ordinance had been amended for this year. All right, let's go to part 1. All right, we are on page 001 in the marked up copy, and there is an 18G. Before 18G, there is a part concerning fair value. The first point there is that for the accounting standard, if it is a fair value approach adopted by the company under certain circumstances, this can be used for tax reporting purposes. 18G and L are the relevant parts. If 18H is used, there can be a choice made by the taxpayer. And then 18J, K, L, its definition and its impact is also explained. Basically, if fair value basis is adopted, the profits may include unrealized profits. As for interest, the actual interest rate or the effective interest rate will be adopted rather than the contract or contracted interest rate as basis for calculation. And further, concerning profits or profits and loss, and also expenditure and revenue, the financial accounting standard will be adhered to. And number 5 pertains to special situation, as in credit provisions or when we go to and also when we go to clause by clause, we can go through this. So we will have to go back to the financial statement accounting standards before we can understand this. Now, the notes often appear in the bill.
The notes should not be conflicting with the DIPN. But does the note enjoy a higher status than the DIPN when there is a conflict? Have you considered that? Chairman, your observation is correct. When we draw up the DIPN, there might be conflicts between it and the note, because the note is about principles, talking about the legislative effect on the sections, and they have nothing to do with the technical details. Okay, let's move on to 18G then. This is 18G. First, that is the word recognize. We have to look at subsection 2A. And then specified financial reporting standard. It refers to the Hong Kong Financial Reporting Standard 9 issued by the HKCFAR. HPA and the International Financial Reporting Standard now issued by the International Accounting Standards Board. B says that in relation to a person for a year of assessment for which the person prepares financial statements in accordance with the standard referred to in paragraph A means that standard. Subsection 2 refers to the definition of recognize. Recognize refers to the fact that 18H and 18I means the same. And in 2B, it's if there is no definition of 18H to L, and if it is defined in the accounting standards, then we should go by the definitions of the accounting standards. The legal advisor referred to the effective rate, and that is set out in the accounting standards clearly. And some people talk about credit impairment. In the appendix of the accounting standards, there is clear explanation. Now let's move on to 18H. Wait, please. The legal advisor has a question on 18G. In the Chinese version, in 2B, in Chinese, 有关条文 will replace in this section or section 18HIJKL. In Roman letter 2, why do we have to set that out clear again? If that is set out again, why do we have to shorten it in the first place? The government's response is that this related 有关条文 in Chinese will be repealed. So can the government confirm whether there will be an amendment on this? The legal advisor's understanding is correct. We agreed to a relevant or corresponding amendment. Okay? 18H. Thank you, Chairman. The person can make an election here. That is what it says set out. The person must prepare financial statements in accordance with a specified financial reporting standard, and he has to elect in writing the approach to act. Now, if he wants to change from the realization approach to fair value approach, there is no specified condition or requirement. The assessment year is set out here, and it says that it has effect for the election year and all subsequent years of assessment and cannot be revoked. And subsection 3 says that if he has opted for the fair value reporting, then, well, let me put it in the most simplest term. Well, for the opening balance, it has to be denoted that it is done under a fair value basis or reporting approach. And the assessable profits so that the assessable profits will meet with the fair value criterion. Subsection 4, the election may be revoked with the commissioner's approval. Subsection 5, the commissioner, well, it sets out under which circumstances the commissioner will agree. And the first one is that there are good commercial reasons and that avoidance of tax is not the main purpose. And subsection 6, if after a person has made an election, the person ceases to prepare in accordance with the specified financial reporting standard financial statements. For the basis period for a year of assessment, the election ceases to have effect from the year. In other words, if he goes by fair value reporting that year, he can continue to do so. But in accordance with the financial reporting standard that doesn't apply, then he doesn't have to use it. And subsection 7, if an election ceases to have effect from a year of assessment, then we have this concept called cessation year here. And sections 18I to sections 18L do not apply to the cessation year and all subsequent years of assessment. And likewise, for all the closing balances, they have to be reported under the historical course. So that has to do with a 7B. Legal advisor, any question on this section? For 18H, if the person opts for the fair value reporting, then in accordance with this law's provision, he cannot revoke it. And this fair value basis will be used subsequently. And then the provisions also allow that under circumstances, the taxpayer can make an application to revoke the earlier option and then maybe switch back to the realization reporting. That has to be approved by the Commissioner of IR, and he has to be satisfied that there are good commercial reasons. What do you mean by that? Do you have to define or give examples? And in his reply, he said that, or say, for mergers, situation whereby the parent company will use a different standard, then this is considered good commercial reason. Now, maybe the fair value reporting has been changed to realization reporting later. Well, I have asked the IRD, the taxpayer can change back to fair value reporting, because if you want to switch from realization to fair value, you don't have to offer an explanation. So theoretically, he can change as many times as he likes for the option to be for the approach to be adopted. From fair value to realization, you have to explain and you have to get approval. But if, say, there are 5 or 6 mergers and acquisitions, and you can switch frequently, right? Yes. If for a revocation, good grounds have to be given. And later on, if he wants to switch back to fair value, then that's okay, accepted. There is no definition for commercial reasons. And in some other ordinances, they don't have a definition either. So we would use a common sense approach to understand what we mean by commercial reasons. And mergers and acquisitions is just but one example of such commercial reasons. There may be other examples. All right, 18I. Let's move on to 18I. And that has to do with effect of sections 18J to L. Subsection 1. This section applies if 18H is chosen, and that is a fair value basis is used. And subsection 2 have to do with regulatory capital security. And 17C and 17D will remain. And subsection 3, from sections 18J to 18L would apply, despite the part relating to profits tax in Part 4 of the IRO, to which extent would that apply? In other words, Part 4 of IRO will apply except in 3A and 3B. And what is 3A? Which, under what circumstance will Part 4 not apply? For example, realized, received, receivable, accrued, paid, payable, or incurred in relation to tax is being adopted. Under the IRO, these wordings are related to the realization principle. And for 3B, we're talking about the calculation method, or called the computation method. And that has to do with profits and expense. Maybe in profit, we are calculating it by the effective rate. But for the realization approach, we are using contractual rate instead. So put in the simplest terms, we do away with words like accrue, etc. But rather we would be using words like increase or decrease in calculating fair value. And subsection 4, the sections 18J and 18L apply subject to the other part for provisions. Any question on this part? On subsection 2, regulated capital security. I think it's a complicated issue. Maybe only the banks are interested. But then can the IRD brief us on the meaning of that RCS? Sub 17C or 17D have to do with regulated capital security. And 17C is about the issuer. And 17D is about the affiliated instrument holders. And maybe the credit worthiness of the issuer has changed, and as a result, there may be a profit or loss resulted. And so for such credit worthiness will be disregarded. Credit rating will be disregarded. And 17C and 17D follow the UK approach. And let's move on to 18J. This is a provision on major principle. So in relation to financial instrument, we would like to align the accounting treatment and the tax treatment. And subsection 1, if 18H is opted for, and that is at the fair value basis is opted, then the 18J will apply. And subsection 2 says that subsection 1 applies subject to sections 18K and 18L. And 18K and 18L have to do with special circumstances. And subsection 3, we set out what is meant by the tax relevant in amount, and that is the assessable amount. And B is the accounting relevant amount, and that is in accordance with accounting reporting principles, the amount to be taken on board. And subsection 4, and that is a financial instrument that is measured at fair value through profit or loss. It says that it will be abide following the HKCFAR standards. And this has to do with financial instrument measured at fair value through profit or loss if the interest is generated from that financial instrument, then that will be measured at fair value through profit or loss. And for B, if the person incurs interest on any money borrowed by the persons, the amount of interest allowable as a deduction is the amount recognized in profit or loss in accordance with the Hong Kong Financial Reporting Standard. And C has to do with debt security. And if the person derives a gain from a discount or premium on the debt security, the amount of gain chargeable to tax is the amount recognized in profit or loss in accordance with the financial reporting standards. D, if the instrument is a debt security that the person issues at a discount or redeems at a premium, the amount of discount or premium allowable as a deduction is the amount recognized in profit and loss in accordance with the financial reporting standards.
So it basically talks about the treatment for tax. Bracket 5 is basically the same as bracket 4, but basically this is about the amortized cost or fair value through other comprehensive income. For the measurement of financial instrument through these means, it talks about the effective interest rate method as well. Chair, this basically is the same as bracket 4, and the wording and presentation is the same as well. All right, noted. For 18K, it talks about the financial instrument special treatment or impairment loss, which is more technical in nature. Today, I want to conclude our clause-by-clause discussion here. Next meeting, we will start from 18K. Any other business members for this meeting? If there are none, I have the following proposal to make concerning the date of the next meeting. Preliminarily, let's make it the 8th of January 2019, Tuesday, 2:30 to 4:30. We hope that the government can respond to the deputations points, and if there are other amendments, then before the 8th of January, hopefully the government would be able to provide those documents to the members of this panel. There being no other business, I declare this meeting concluded. Merry Christmas and Happy New Year to all.